We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Brandon Munro, CEO and Managing Director of Bannerman Energy. Brandon, thanks for joining me today.
It's a pleasure, Tom. Nice to be talking.
Excellent to have you on the show here. And of course, you're one of the uranium, let's say, Twitter gurus, and really looking forward to kind of digging into the conversation here today. So why don't we start by giving us a little bit about your background and some of the roles that you play within the industry?
Well, I come to the sector with a fairly atypical background. I'm a lawyer and an economist by trade. But what that did is that gave me an insider view of the extent of some of the corporate activity that took place during the last boom. So my background as a lawyer was in mergers and acquisitions. I worked in, the big firms in big glass buildings on the very big end of the transactions. And being an epicenter of the resources sector here in Perth, Western Australia, we did have access to really interesting deals, including some of the more epic mergers and competitive acquisitions during the last uranium boom. And in the uranium sector per se, I've worked since 2009. And I've spent 6 of those years living in Namibia, which is where Bannerman Energy has its project, and originally went there with Bannerman in 2009 and had some wonderful experiences during that time, not only living in Namibia, which is a beautiful, safe, secure country with wonderful people, but also in the industry itself. They've got a very well set up industry body called the Namibian Uranium Association, and I was a trustee of that and also governance advisor to that. And that morphed into a little bit more representation at the peak industry body globally, which is the World Nuclear Association. So I've been a fairly regular speaker at their events. And over the last 4 years, I've co-chaired a body called the Nuclear Fuel Demand Working Group. So what happens is WNA puts out a flagship publication every 2 years. It's the Nuclear Fuel Report. And this working group is responsible for forecasting nuclear fuel demand, in other words, uranium demand, globally out to 2040. So it's a privilege to co-lead that group. And it's obviously a very interesting experience. I can compare our own in-house modelling of the uranium sector with how WNA goes about it. And I'm rubbing shoulders with really the most insightful analysts in the sector as a result of that. And it's a great collegiate opportunity to talk to people across the nuclear industry.
Yeah, it's really interesting, Brandon. And we'll kind of touch on some of that a little bit later, trying to determine, let's say, where long-term prices are headed, and some of the considerations that the utilities are going to need to, start taking into account here fairly soon. So obviously the big piece of news has been the Sprott SPUT fund, and it's up to about 28 million pounds of uranium has been bought. So can you start by telling us a little bit about what a big development this has been for the sector?
Yeah, it's hard to know where to start, and maybe we'll take this apart bit by bit. Mm-hmm. So it started in late April, where Sprott Asset Management, which I'm sure your audience is well familiar with, they made a decision that they would acquire Uranium Participation Corp. And since that decision was, I suppose, settled and the transaction was completed, they've acquired an additional 10 million pounds. So they had a good starting point. And in the intervening period between the announcement of the deal and it completing, Uranium Participation Corp raised more money and bought more pounds. So they took advantage of their own momentum to do that, which I thought was rather neat. So the reason it's such a big deal is that this sector has operated without effective price discovery for really quite a long time. Traditionally, the uranium sector operated according to long-term contracts. And the spot market was really only used to sell overproduction or scrape back underproduction that could then be delivered into these long-term contracts. And then as the Kazakhs started to develop their tier one uranium assets that they inherited from Soviet times, they became more of a dominant spot market seller initially. And that contributed to a number of different distortions in the sector, and it drove down prices to levels that spent years at patently unsustainable and uneconomic levels. So that was the deep bear market. That's when people like myself really earned our stripes. I took over as CEO of Bannerman in 2016, and I've become a good practitioner of stewarding a company through a bear market. I can tell you that much. Now, because the uranium price was trading so low, it meant that a large proportion of world mine production was uneconomic. Some of it even loss-making. And therefore, from 2017, we started to see a combination of supply discipline from the majors. So that was Kazatomprom, who operate all of the Kazakh assets, and Cameco out of Canada, who operated both the McArthur River and the Cigar Lake mine, the two largest mines in the world. So McArthur River is still on care and maintenance as a result of that decision. And in addition to that, those deliberate moves, we've seen a number of projects either run out of ore, such as in the Ranger project in Australia or the Cominac mine in Niger, and also mines that became so uneconomic that they needed to close down and be put into care and maintenance, such as Paladin Energy's Langer Heinrich mine. That is not a normal situation in a market. That is a market that clearly is operating under a mechanism for price discovery that simply doesn't work. And even more recently, we've been operating at a significant sector deficit, and the liquidity going through the spot market was so low that in the face of a deficit, the price could continue to drop and continue to wallow at around $30 a pound. And the liquidity had a big impact because no matter what's happening in the market, there is always a baseline level of producers who produce very cheaply. It's material from in situ recovery, say in Uzbekistan, or byproduct material coming out of BHP's Olympic Dam mine in Australia. And that material just simply gets sold into the spot market come what may. And if there isn't much buying activity and lack of liquidity, the market sinks down to what those low-cost producers or byproduct producers are prepared to sell it for. And that's where we ended up with this tremendous distortion. Enter SPUT, and they've been buying at quite a significant run rate since they launched their at-the-market facility about 6 weeks ago. And as a result of that, they've achieved that price discovery in the sense that the demand has bought through these sellers who have very cheap spot material and started to draw out from other sources of supply, such as commercial inventories. And what we've learned from that is that there obviously isn't an awful lot of commercial inventory because the price has gone from $28 in March to about $50 in the last week. So very significant price appreciation. And that's been the fundamental immediate term effect that it's had on the market. And we can come to talk about what some of the short-term and medium-term effects are a little later.
Mm-hmm. And as you mentioned, like this was one of the sharpest spot price increases in uranium ever, right?
Correct.
So what are some of the positives for the market? Could it also reveal just how big the mobile inventory is? And is it good for the transparency of a typically very opaque market?
Absolutely. So the mobile inventory debate. So for folks who don't follow uranium sector in detail, there's a bear market case, which is there's an awful lot of inventory and the holders of that inventory have just been praying and wishing that they get the opportunity to belt it into the market. And the alternative case, which is the more bullish case, is that, well, there is some inventory. However, We don't know how much it is. We suspect there isn't very much, but we can't prove that. And I've always maintained a position towards the bullish side, which is there's a lot of mobile inventory when no one thinks the price is going anywhere. But the moment the price starts to move, the holders of that inventory suddenly hold it close to their heart and close to their chest and realize that they built up that inventory actually for a reason, and that was supply mitigation. And the moment supply risk becomes an issue, you need to go back to what is your primary mitigant, and that is commercial inventories and long-term contracts. So you're absolutely right, Tom. We will know really by the end of the year which one of those theses is correct. If there is a huge amount of mobile inventory out there and the holders are just rubbing their hands because their hopes and prayers have come true, then SPUT and every other market participant is going to get filled in and the price is going to recede. It'll recede back through $40. If, as I subscribe to, there isn't that much mobile inventory, whatever there is will get shaken out. That's very healthy for the sector, and it's very healthy for the next few years because that overhang will be removed. And what we'll have is, in fact, a situation where traders will not only take current overhang out of the market, but they'll start to create instruments to bring forward future overhangs so that they can sell it at these prices to spot in the immediate term.
So, Brandon, you've spoken before about something that you call the uranium virtuous cycle. So how does this SPUT actually start that cycle and really act as a maybe a catalyst for a flywheel effect for demand for the industry?
Yeah, so thanks for picking that up from Twitter. So I first put this slide up actually to the industry, the World Nuclear Fuel Cycle Conference, which was held in Miami back in the days that we could fly around the world in 2019. And I was talking to mainly market participants, fuel buyers. There might have been a couple of uranium juniors in the audience, and saying, look, these financial players are coming. The nature of the finance sector has changed fundamentally since the last boom in uranium from 2004 to 2006. So utilities and market participants can't just simply take that playbook and replay it. And I tried to foreshadow my view on what was going to happen. And that was even before COVID, even before expansionary monetary policy, which have now taken this whole dynamic next level. And so the concept of this virtuous cycle is really quite simple. It's a financial investor, and now it's SPUT. They raise money via their at-the-market facility on a day. They have the immediate confidence that they have that money in the bank because the at-the-market facility enables those shares to be sold. And then they go and they buy pounds with those shares, with those units. The buying of those pounds increases demand, which, as we've seen, then increases the price of uranium. And that drives sentiment, which drives further demand back into SPUT units on TSX, enables it to trade at a net asset value premium, which is one of the preconditions for them utilising the at-the-market facility. And so they issue more units, create more money, buy more uranium, and so the virtuous cycle continues. Now, where it gets really interesting is when you start to incorporate other market participants into this. So, for example, that cycle spun really hard, almost entirely because of SPUT in the first 3 weeks. So there was a lot of engagement. There were a lot of market investors really who saw just how patently cheap uranium was as it was moving from low 30s into the 40s and into the mid 40s. And SPUT was able to raise a lot of money very quickly. They've pulled about $400 million out of investors on the TSX alone. And so that flywheel really spun. And what we're now starting to see is it's not just SPUT doing the buying. We're now seeing other market participants. So traders come into the market, producers come into the market who need to buy uranium to deliver into long-term contracts. We're seeing utilities finally entering into the market because they figure, well, we've watched this price go up 10% a week for the last several weeks. We're going to have to actually engage with our procurement strategy and make some decisions here. Mm-hmm. And some of those utilities, particularly utilities who have had their premature closures of reactors saved by government policy, they've now got reactors that they're buying for over the next 3 years that they expected to be closing literally right now. So that's created extra demand, which is then maintaining price pressure, and so the wheel spins. And where it gets really fascinating, and this is where it's different from the last cycle in particular, the last uranium boom, is the presence of passive investment money and robotic buying. And in our case, and your gold audience knows it only too well, but we've got a fairly dismature ETF sector in uranium, but we've still got a couple of decent size ETFs relative to the size of equities. We're still little players in uranium when it comes to equities. We are growing, but we're little babies here compared to bigger commodities, in particular gold. Now, these ETFs have grown about tenfold in the last year, and the two big ones are currently represent about $2 billion. Again, small change, but bear with us, gold bugs. They, interestingly, hold in their index substantial proportions of physical uranium investors. So URNM, which is listed on New York, they hold about 8% of their index is SPUT. And then URA, which is the oldest and largest of the ETFs, by a quirk, they dropped SPUT out of their last index rebalancing. And that's because the acquisition took place literally, so the acquisition of Uranium Participation Corp by SPUT took place literally across an index rebalance date. So it didn't exist on the 3 business days in which this was done. Now, an absolute fluke, which set them back a bit because they had to tip out all of those, URA had to tip out all of those Uranium Participation Corp shares. But what it's done is it's set up a beautiful trading opportunity when they next need to rebalance, because they're going to have to go back in and probably, buy circa 10%, or however they rebalance, whatever the market cap is back then. So there'll be some fairly intensive buying of SPUT just after Christmas because of that dynamic. Now, once they've set that up, that flywheel then has the extra dimension to it, because the increasing price and all of the interest that it's creating in mainstream media and amongst generalist investors drives money not only directly into SPUT, but indirectly into SPUT through the robot buying as investors pile into these ETFs to get broad-based exposure to the equities talk that you get through, playing a commodity in a leveraged sense through the equities. So there's a lot to it. It's fascinating, and I think it's got a long way to run. And I think the early indications of momentum that we've seen, whilst I don't think it's reasonable to project that type of trajectory continuously forward, I do feel like there's enough momentum to discount the scenario where this is just a temporary blip and then we're going back to boring 30s in terms of the uranium price.
You mentioned projecting out a little bit, Brandon. What percentage of global annual production could we be seeing out of SPUT? I know you built a table kind of projecting out as we're talking about. So how big of a percentage are they actually sucking up at this point?
Well, over a month, they've sucked up on an annualized basis about 80% of the uranium that's being mined around the world. Now, that's dramatic enough, but remember, most of that uranium is being delivered into long-term contracts. So most of that uranium is committed. So it's not like they're buying most stuff from the mine. Most stuff from the mine is already pre-sold and pre-committed. If that type of momentum continues, then we're talking about a fundamentally disruptive effect on the uranium sector. And there's various ways in which that will play out. Now, as with any projection, I'm a believer that you have to work in probability scenarios. And it's not a reasonable assumption as we stand today to ascribe that scenario the most probable. The most probable is it will ease off. But even if it eases off to 100,000 pounds a day, which is what SPUT has been doing on a lazy day, that's still 20% of the world's production, and that still doubles the current structural deficit that we've got between what is produced in uranium and what's consumed by nuclear reactors. So it's going to have something between a very market effect on the sector and a totally disruptive effect. And the reason why I think you have to work in scenarios is this isn't about trying to apply science to a mine or putting something into a spreadsheet and trying to model it. It's not about trying to understand supply and demand at an industrial level. This is trying to take a guess at what broad-based investor psychology could possibly do here. And that's where some of the very, very bullish scenarios that we hear about are coming from. A number of commentators are making links between some of the really extraordinary, crazy stuff that we've seen, particularly amongst Stimmy Check investors and the Reddit crowd and so on. That is a scenario. I'm not going to give it a probability as a scenario. However, any market participant, particularly the traders, they need to keep at least one eye on something moving in that direction. And then the other scenario that plays in with this is the whole ecological scenario here in green finance and ESG, because we need to remind ourselves we're playing in a sector that is fundamentally at an absolute foundation level positive ESG and positive green, because it is simply, nuclear power is simply the most effective alternative that we currently have as a civilization for addressing climate change and addressing decarbonisation. It's still got some way to go politically in a number of markets, but at a science level, even after taking into account risks and waste and all of the potential detractions from it as an energy source, it hits the ball out of the park if our objective as a civilization is decarbonising. So by producing the uranium into that, we are, by definition, amongst the very greenest organisations on this planet.
I'd like to get to that a little bit more, Brandon. But before we do, you mentioned the distinction between SPUT trading on the TSX versus the New York Stock Exchange. So I've heard that their goal is to be listed in New York. So what things need to fall in place for them to be able to do that? And would you put a probability of that happening, considering I've heard rumblings that regulators might get involved to kind of step in to secure fuel supply for actual utilities that need to get it?
Look, it's a pretty wide open question, Tom. Yes, they are committed to applying and working through the SEC process to get the investment trust listed in New York. And I think Sprott have flagged circa mid-2022 for that. So it's got a long way to run, and they're expecting and planning for it to be an elongated process just because it's novel. So I'd say a couple of things about this. The first one is I regard it as being icing on the cake, not the be-all and end-all of the effectiveness of SPUT as a vehicle for investors and as a vehicle for price transparency in this market. The two things that Sprott did that were incredibly clever and very effective was, first of all, they created a US dollar unit. And that has dealt with 90% of the friction for US investors, particularly institutional investors and big money investors. If they're dealing in a US dollar unit through Sprott, by and large, they're going to be comfortable investing in TSX in that way. It's removed the friction from exchange rate and various other aspects. Now, yes, it'd be more convenient if it's on New York, but it's doable on TSX. And we're seeing that with some of the flow of funds at the moment. And then the other thing that we've talked about that was incredibly clever is the way that they've implemented the at the market. And that's important because institutions coming in and wanting to position in a traditional raising, they either need to try and build up a meaningful position on market without moving the stock too much. And that's really hard for big investors, or they need to wait until there's a formal capital raising. And then they go through all of the jostling and positioning required to try and edge out their competitors. And when they really want the stock, they can't get it because everyone else wants it. So what this means is they can basically fill their boots on market. They can put a bid on market. They can put a block trade through, knowing that SPUT has got the capacity under its shelf prospectus to issue, as we stand today, up to about $800 million US worth of new units. And once they get to the end of that, they can start again. So they're the two most important things. And New York would be icing on the cake. And I think that will be an enabler, probably more for retail than institutional money. And the way that I think about that is it presents a longevity to this momentum. So this momentum, it's going to go up and it's going to go down, and it's in a slightly flat period at the moment, and that's absolutely fine. That's normal. I'd be worried if it wasn't. But we've got ETF rebalancing to look forward to early in the new year, and then potentially we've then got the New York listing to look forward to somewhere in the middle of the year. There are some challenges with it. It's not like it's been done before. The regulatory aspect that you've highlighted, by and large, I would see that as more of a sort of a sophisticated box-ticking exercise. As we currently stand, I don't see a large risk that the SEC is going to try and play God in markets on this particular instrument. However, there remains a risk that, particularly with some of the rhetoric that's being thrown around in terms of squeezing and cornering markets, and some of the rhetoric in terms of, once it's on New York, the Reddit crowd's going to come in and send this to the moon and we're going to make it like GameStop. That's actually not particularly helpful, because that potentially creates an avenue that regulators might be concerned about. They might look at that and they might say, are we really just blessing an instrument here that's designed for market manipulation? And that's where the real concern could come. Mm-hmm. It's something that we're going to have to watch, but I'm not losing any sleep about it, because the main work and the main structure is already so effective for what it's designed to do, which is offer investors exposure to uranium, simply because you can't buy the drums and put it in your office and store it that way. This is the most perfect solution that we've got today in financial markets for owning uranium.
And as you say, you can't just go and buy it. And same with the trust, there's no redemption option for this, right?
Correct. And that's important to understand for people out there, and something where many of the market players are still grappling with their understanding of this vehicle. Unlike an ETF, it doesn't have a redemption capacity that's built into the trust document. So it needs a lot of unit holders to vote to be able to change that. And so the significance is this will assist in price transparency on the way up in this market, but it's not going to deliver death knell blows on the way down like a dominant ETF can. As this sector moves through the current bull cycle, as it inevitably will turn, probably a long way from now, but inevitably it'll turn, it'll soften. This vehicle will just simply trade without issuing new units very often, because it'll probably trade at an NAV discount. But I do think that's a long way off. The reason it's so important is the effect that it will have on the psychology of existing market players. It'll take a little bit of time for utilities, the end users here, to understand that actually this isn't about this vehicle hoovering up pounds today so they can sell it to us when we need it in 4 or 5 years' time and be grateful with the 30, 40, 50% profit they're making. That isn't what this is about. It's about creating a synthetic instrument that as closely as possible matches owning uranium. And owning uranium for good times, owning uranium for bad times. There is always two sides to a trade, and therefore the value of having this instrument will be there no matter what point of the cycle we're actually in.
So you're the chair of the Nuclear Fuel Working Group. Remind me again what the actual name was, sorry?
So there's the Nuclear Fuel Demand Working Group. Mm-hmm. So we put together this report, and we've got 5 different working groups that focus on different things. So the Demand Working Group focuses on projections for nuclear power around the world and how that filters down into demand for uranium conversion, enrichment, fabrication. And then we've got various supply-driven working groups that focus specifically on the uranium, on the conversion, on the enrichment, on the secondary supply, and also on the fabrication.
Right. So having that perspective, Brandon, how short and like how much of a deficit are we currently in for uranium being produced versus what is being sucked up by long-term contracts and by the spot market at this point?
Okay, so to throw some pretty consistent numbers to you, the world's reactors consume roughly 175 million pounds of uranium as we stand today. That's both what's burnt up in a reactor and the preloading of reactors that are starting up typically over a 24-month period. In terms of uranium supply, it comes from, let's say, three sources. The first one is mined uranium. That's the one that's easy to get your head around and extremely visible, very transparent. You can't go mining uranium on the sly. There's multiple treaty-level multilateral rules and regulations and enormous governmental input into making sure any uranium that's produced around the world, everyone knows where it is. Mm-hmm. So we've got a really good picture on what's being mined. Then there's what's called secondary supply, and this is uranium that's produced from secondary supply. So I'll give you an example. Tails re-enrichment is taking the tails from the Cold War era where the technology for enriching uranium wasn't so efficient and re-enriching that. So using today's enrichment technology to squeeze a little bit more of the useful uranium out of those old tails. So very analogous to going to a 1900s gold mine and reprocessing the tails dump, just because someone's left, let's say 0.5 gram per ton in that dump. So just as with that scenario that I described, it's relatively cheap pounds as long as you've got the enrichment capacity. To build new enrichment capacity, it would never make sense because that is a very expensive industrial process. But if you've got the spare capacity, push those tails through and you're getting uranium very cheap. So that's secondary supply. And then the third category, which is the deficit, is inventory drawdown. By definition, that's the only thing it can be, right? It's so that inventory drawdown is operating at about 20 million pounds per annum, and it doubled during 2020 because of COVID interruptions in Kazakhstan and in Canada as well. So 20 million pounds out of a market of 175 million pounds, and the uranium sector is traditionally very finely balanced between supply and demand. The demand is remarkably consistent for an industrial metal or for an energy metal. There's a little bit of political closures that can punch a hole in demand, as we saw after Fukushima, but generally speaking, it's pretty steady state compared to, say, copper or nickel or iron ore or whatever else you want to look at. So that's a significant deficit. And at some point, that inventory drawdown has to give. And that's where SPUT's really fascinating, because apart from simply what it's been buying, so in 6 weeks, it's bought 10 million pounds out of the market, which is half of the deficit on an annual basis. But what it's also doing is by creating an upward price spiral, the levels of inventory that market participants are carrying suddenly look pretty appropriate. They don't look, we've got too much of this stuff, because why don't we sell it today and buy it back at the same price in 4 years' time, which has been the mentality, over the last 7 or 8 years. That's been the mentality, and, correctly, as it turns out, that no longer applies. So participants holding inventory see it as an investment now, not as a lazy corner of their balance sheet that should be working harder.
So exactly as you mentioned there, Brandon, the corner of their balance sheet that is just kind of sitting there. What is the carry trade, and how does that play into this model as well?
So carry trade is incredibly important, and I think it's worth us just going into a little bit of depth, and particularly for a gold audience who would understand hedging really well. I forgot to mention when we were talking about my background, but I was involved in the largest hedge book closure in 2005. So I worked for Oceana Gold in those days, and we closed out our hedge book. It was million-ounce hedge book closure. So that was really fun. So I do know a little bit about gold hedging as a result of that. And it's much simpler in this sector. So the uranium derivatives are very immature and very simple. And the go-to for traders is called the carry trade. And this has really interfered with normal market mechanisms, particularly since Fukushima, when the market's been oversupplied. So this is how it works, right? So a trader looks at the spot market and figures, yeah, we can buy uranium at, let's say, $30 a pound. And it's all been pretty slow and it hasn't really moved. And we're aware that there's quite a few parties. If we offered them $30.20, we could probably squeeze another 200,000 pounds out of them. So when the market's doing nothing, the traders have got a really good, confident feel for how many pounds they could buy today in the spot market. So they pick up the phone, they go to the utilities and they say, do you think you might need anything in 18 months or 24 months or maybe even 30 months? And the utilities go, well, funny you should phone, because we were just saying yesterday, we're going to need 100,000 pounds in 28 months. Can you quote it for us? So the trader then goes to his spreadsheet, works out his cost of finance. If he's working, say, within a Macquarie or someone like that, it's really cheap because he's using the house finance. They work out what it would cost to buy it today, what it would cost to store it for 28 months, how much the finance would be, and then they put a nice little tasty fee on that. Phone the utility back. Look, we can do it for you for $34.80 in 24 months' time. The utility goes, oh, bargain. That was really easy. I don't need to worry about long-term contracting and negotiating with people. We'll take it. And so the carry trade deal is done. The trader finances that, knowing that they've got a very secure counterparty to sell that material to them in 28 months' time. And the profit is locked in at that point. This has been so simple, absolute bread and butter for the traders for the last several years. And it's created a level of complacency amongst utilities, because very rarely has the phone call come back saying, oh, geez, you want £500,000 pounds. Oh, I don't think we can get that without moving the market. Maybe let's make it 200 and we'll try again next week. In an oversupplied market, it's all been, how much do you want? We'll just add our fees to it. No worries. This is good money for traders. Mm-hmm. So I wanted to spend a bit of time on that, because this is what's so important about SPUT. All of a sudden, the traders can't get that material unless the utility's prepared to pay those premiums on $50 uranium, which they're not at the moment because they're waiting to see what happens. So it's just instantaneously cut the carry trade off at the knees. And at best, the traders were able to maybe do small amounts of carry trade on the way up. And in the early stages, when it was moving from, say, $35 to $36, they might have been able to squeeze in 100,000 pounds here and there. But with SPUT relentlessly buying there, they would have competitively bidded up the price. And even doing that makes the mechanism hard to work. So for now, at least, the carry trade is not operable. Now, what are the implications of that? Importantly, it means that the utilities will need to either buy spot themselves, which they haven't been doing much of so far. I think they're a bit confused as to, or concerned about what's happened to the market, and they're wondering if it's just simply going to come down again. Or they need to make sure that they buy what they burn. So back to the inventories conversation, they start to think, well, gee, if we can't get that carry trade material, maybe we ought to be pretty pleased that we've got 2.5 years worth of material, rather than 6 months ago when we were thinking, what on earth are we going to do with this stuff every time finance upstairs nags us about carrying so much on our balance sheet. Or they say, we're going to have to start thinking about long-term contracts, because we can no longer kick the can down the road 2 to 3 years at a time, which is what they've been able to do via the carry trade for several years. The material that they're getting delivered today under the carry trade that they might have signed up for 2 or 3 years ago, traditionally, that would have been material that they would have been receiving under a long-term contract signed up 5 years ago. So we've had this long, elongated hole in long-term contracting simply because of the effectiveness of the carry trade and how attractive it is to utilities. And that's gone. And it might reestablish itself if the market gets used to uranium sort of $45 to $55 and it settles there. That's a possibility. But then it's a carry trade based off $45, $55 uranium wherever it is, which is great for companies like us and any of the other advanced exploration companies and developers who can come into production in the next few years.
So considering that $45 to $50 price level for SPUT, what is an optimal, let's say, price level for the long-term contracts?
It's more than that. It's more than that. So the sort of pricing that we're at the moment, so it's jumping around a little bit, but let's just say $50. The only mines of any scale that $50 uranium can justify is the return of the mines that went on to care and maintenance, that were losing money at $30 but now can make money at $50. Now, there's a separate aspect to that, which is, will their owners turn them on at $50, or will their owners say, well, I'd prefer to let this market just tighten up a little bit more and I would prefer locking in $60 rather than $50. But let's put that to one side. Those mines could make money at $50. But we're dealing with a sector where supply is depleting significantly over the next decade. And that's what those World Nuclear Association graphs really bear out. Last year, we had 2 of the top 10 uranium mines in the world closed because they've run out of ore. That was Ranger and Cominac. We've got another 2 of them scheduled to close this decade. And a number of those Kazakh assets that were inherited from the Soviet era, they're also depleting in terms of their production. So even if the sector did nothing else, even if another nuclear power plant was never built, we've still got this supply depletion that needs to be filled from somewhere. And against a backdrop of desperately low reinvestment into new production, very little investment into new exploration, very little investment into development, particularly by the majors and obviously by public markets. And you can't play catch up very quickly in the uranium sector, apart from the fact it's mining, and just like gold mining, it takes a long time. If I compare it to gold mining, there's a social overlay that really slows things down. There's an environmental overlay because of radioactivity that really slows things down. And there's a political overlay that can draw it to an abrupt and absolute stop for a long time. And just in the last couple of years, we've seen Sweden ban uranium mining, and it looks like Greenland's going to ban uranium mining. 2 big projects that many utilities would have had in their models to come on board over the next decade. So that underinvestment has a very long hangover in this sector in particular. And so, we know that acutely. That I told you that I went to Namibia in 2009 with Bannerman. My job back then, I was General Manager Corporate Development, which I think in your part of the world you'd call a VP. So my job was to get the environmental permitting. And so I know what it takes to get an environmental permit. And thankfully we did. And that's one of the great attributes of our Etango project. It is permitted environmentally. But it's an extraordinary process. It took us millions of dollars. We needed to do it at the most highest possible level that was immune from criticism because it's uranium. Mm-hmm. If it's a copper project or a nickel project, or certainly if it's a battery metals project that goes into solar panels, you cut a little bit of slack. Uranium, you just need to do these exercises assuming that you've got the anti-nuke people combing over it, just looking for any little crack, any little fissure that they can put their hands into and their claws into. It takes money, it takes time, it takes a lot of social engagement, and it takes significant interaction with your regulators to be able to get to that point. So you asked me about sort of what prices need to do. The point here is that a uranium price that can simply bring on the production that's sitting in the wings in care and maintenance only solves a very short-term supply issue in this sector. And then you start modeling, well, what's a price that sufficiently incentivizes the projects that can come on at scale, including our project. So if I use our project as an example, we're a bit of an unusual one because we did a DFS, definitive feasibility study, on a very large version of our Tango project back in the day. We published that in 2015. And more recently, we've developed a smaller and more streamlined pathway to development at £3.5 million. So for people to get their eye in, that's enough to service 7 to 8 gigawatt scale nuclear reactors, which is a very big uranium mine. We put out a PFS and it looks pretty good at $65. So a 20% post-tax IRR at $65. So $65 is good enough for a project like ours to fall over the line. Would we finance it at $65? Well, that depends entirely on what we think uranium's doing in another 6 months. Mm-hmm. There's every chance our board will get to that point and say, you know what, we're not prepared to sign up at $65. We think it's going higher because we're looking at the other alternative projects that we've got and they can't come on at $65. That one might be cheap, but it's still got environmental permitting. That one looks great, but it's locked up in a jurisdiction that banned uranium mining or whatever it is. So my personal view, with all of that long-winded context I've just given you, my personal view is that for a sufficient new production to come on over the next 7 to 8 years, we need to see sustained uranium pricing at about the $80 mark. Mm-hmm. And there is plenty of upside on that. There's plenty of potential for spiking above that over a period of time, as we saw not only in 2005 to 2007, but as we saw in particular during the oil crisis in the late 70s, when in real terms, uranium spent 6 or 7 years above $160 a pound.
Wow. And, it just goes to the old saying of there's no cure for high prices like high prices. But as you point out, there's no way to just flick the switch and turn on more supply, right?
Well, that's it. And then if you bring that back to the now, the earliest supply response that we could see generated by this volatility caused initially by SPUT, we aren't going to see any major supply response until 2023 at the earliest. Mm-hmm. So all of those care and maintenance mines that I've talked about, they will take a lot of time to come on. And the elephant in the room is McArthur River that Cameco have. And they clarified just this week that they're in no rush to turn it back on. They're not going to stop the party anytime soon. The Kazakhs, who have reduced their production by 20% as part of this supply discipline approach, they've promised the London Stock Exchange that they'll continue that through 2023. So the only possibility, going back to one of the other questions, the only possible supply response is if there is indeed a lot of mobile inventory that'll start coming out at these levels and fill SPUT in. And I suppose my reaction to that is, if I'm wrong on that and there is all of that mobile inventory, what a pleasure to have it being locked up long-term in a sequestering vehicle like SPUT. And so I'll be pleasantly proven to be wrong if that's the case.
Great point, Brandon. So as we think about the demand picture going forward, and let's say the application of new technology, what are the demand implications of SMRs and advanced reactors? Could they not take away demand for traditional nuclear fuel in favor of other fuels?
This is just such a cool topic to talk about, right? So first point, not really. And here's the fascinating thing about SMRs or small modular reactors. They're complementary to existing nuclear electricity production. Going forward, projecting forward a long way, there might be some use cases where you say, well, look, we could build 3 gigawatts of conventional nuclear, or maybe what we'll do is we'll stack it with SMRs and we'll build it up a bit slower. But that's at the fringes. That's just a limited example of where the interplay between conventional gigawatt scale nuclear reactors and small modular reactors, which typically are anything between 50 and 300 megawatts, and then you can modularize or stack them up into something bigger. So I don't see a lot of potential for cannibalizing demand. And certainly that's really a unanimous view within W&A circles with the analysts that we're working with. Now, where it is just stunning for the picture for uranium as you project forward and as you look a little bit over the horizon is all of the brand new use cases that SMRs can deliver that conventional nuclear can't. So, for example, remote power supplies. There's a huge amount of diesel that is burnt at remote mine sites, at small islands, northern Canada, both for electricity and for heating. SMRs are the absolute ideal solution. They operate in all climatic conditions. They're green, they're emissions free. They can produce both power and heat. So they can be ideal for district level heating. Then you start to say, well, in the decarbonisation thematic, so here to 2050, a lot of people only really think about decarbonising electricity and electric vehicles. But that's just the easy stuff. That's just the simple stuff. So first of all, decarbonising electricity. SMRs are the solution for weaning communities and economies off coal, because you can quite literally decommission a coal power station and put SMRs in the car park. And one day you switch that one off, you switch that one on, it uses all of the existing grid infrastructure. There's very good signs that you can adapt a lot of that workforce, and you don't cut a whole community off at the knees. Versus what we're doing at the moment in Australia, where we're trying to turn off coal-fired power stations and replace it with a solar field that might be hundreds of kilometres away, not only from the existing grid infrastructure, but from the industry that needs that coal. Or it might be some wind power. Or at best, it might be some future hopes of firming or storage. So you're creating a huge need for additional infrastructure to be built to connect that solar field that's ideally built in arable or desert land a long way from the population centre. You've got to build all those grid lines. You've then got to build a network because you've got to try and spread the intermittency around. And in the meantime, none of that infrastructure wealth gets reinvested in the poor community who've just lost third-generation jobs associated with the production of dirty coal electricity. So it's absolutely perfect. And we're seeing that play out now in Wyoming with the TerraPower, the Bill Gates backed SMR technology. So that's the easy bit. That's electricity, remote, modular. But then you say, what do we decarbonise once we've decarbonised the grid? A massive amount of fossil fuel energy goes into heating stuff, heating industry, heating homes, heating commercial premises. Nuclear power is perfect for that because it creates heat. It creates heat as a byproduct half the time. So it can be both used as an energy source to create heat, and the byproduct heat can be captured for things like heating communities. Then you go to a use case, green hydrogen. This is one of the most fascinating aspects of nuclear power that you can imagine. There's a huge amount of hype around green hydrogen. And today, say Australia, right? A lot of talk about investment in renewable energy that can then be used to, through cold electrolysis, produce hydrogen. Okay, well, it's been proven in labs. No one's actually proven it commercially yet. So there's a lot of work to be done to show that it can be remotely competitive with SMR production, SMR being steam methane refinement of hydrogen, or blue/turquoise hydrogen, however you want to think about that. Coal electrolysis is still a science project to be economically competitive. There's a lot of political and industrial support behind using hydrogen, and I get some of that. But SMRs, particularly there's like a branch of SMRs that operate at high temperature. They can produce hydrogen in today's technology very economically, and they can produce it wherever you need it. One of the big problems with hydrogen is you've got to transport it around, and that's expensive, and it's got some issues, and the stuff does blow up if you don't treat it carefully. Moving forward, I can envisage where industrial centres that need hydrogen for living, for industry, for whatever they need, they just have a high temperature SMR there that makes the stuff. And when it's not making the stuff, it produces power and process heat, and also produces district level heating. I can go on. I can go on and on that. There's so many, there's 70 different SMR designs right now that have these different use cases. But to come right back to your question, Tom, this is an enormous potential increase in demand. And the group that I've been working with in WNA, we had to make a decision that it's way too dynamic to try and forecast. We, as a body, we need to operate pretty closely within what's predictable. Mm-hmm. And this is, at the point that we ran our numbers and published, which was 6 months ago, it was just not predictable enough. We had to say this is a future source of demand. Mm-hmm. And that's an absolute game changer for our sector. The question just becomes, how soon does it come into being? How quickly can we see these designs commercialized and generally available? It's a very, very exciting aspect of the sector, not only from an ecological point of view, but also in terms of maintaining communities, maintaining industrial competitiveness, enabling third world and developing countries to actually industrialize and urbanize and improve the standard of living of their people. Because we just heard that China's not exporting coal anymore. So where do those countries and communities get their power from? Mm-hmm. Intermittency, building a grid from the ground up with intermittency, with solar and wind, apart from being quite expensive in the developing world, it just doesn't make sense. So I'm excited. You can probably tell that.
Absolutely. And, as you bring up the non-predictable nature of SMRs, we've really seen this, I think, somewhat of a shift in opinion and attitude towards nuclear energy since Fukushima, and maybe SMRs and more projects like that will help shift more of that sentiment against nuclear power for something that is producing heat and electricity that is carbon, what would it be, carbon neutral, right?
Well, I can tell you exactly. So the IPCC put out kind of what has been the conventional wisdom on life cycle assessment of the carbon impact of various energy sources. Mm-hmm. And nuclear came out together with onshore wind at the lowest. 12 to 14 was the measure there. So that's carbon equivalent per kilowatt hour. Now, what's awesome is the UNECE. So that's the United Nations Economic Commission for Europe. I'm a expert contributor to UNECE on matters of uranium, and been involved in a recent report that they've done. They've released another report for public consultation. I'm not involved in this, but I love what they've done. And they've produced a contemporary review of all energy sources and what their life cycle assessment impacts are. Nuclear's now come in at 5.6. So nuclear power is by far the lowest carbon emission source of electricity. And onshore wind stayed up at about that 12 level, I believe. So yeah, it's not emissions free because you still have got a few mines and you've got a bit of concrete to build plants and you've got some metals that goes into it. Mm-hmm. But it's the closest thing that humanity's got to emissions free. And anyone who wants to have a deep dive, it's well worth going to that UNECE report, life cycle assessment.
Excellent. Maybe we can link to that in the show notes for our listeners. Brandon, I really appreciate all your thoughts on this subject. Is there anything else that you think that our listeners need to be aware of, or that is on the top of your mind before we wrap up here?
I think we've covered it off pretty well, actually. There's one thing that we haven't talked about that's pretty proximate to, I think, a lot of your audience, which is reactors that are being saved from premature shutdown right now. And this is a very new topic. If it wasn't for SPUT, this is what I'd be talking to everyone about, because it is that important. And so in the US, the nuclear industry has been in decline pretty much since Fukushima. And that's because a number of reactors that are in perfect operating condition, that are working really efficiently, they've been closed down. Some are for political reasons, such as Diablo Canyon in California. And I'm still hoping and optimistic that that craziness will subside. But others, it's because they've been pushed out when gas was like $2. And it's very hard to compete with very cheap gas on the one hand and subsidized intermittent renewables on the other. What's just happened since the Biden administration came in is we've now got bipartisan support in the US for nuclear power, and strong support. And it's one of the areas of this Biden administration that's actually functioning because it's getting support from the Republicans. You know, it's the area where they're not fighting each other tooth and nail. So things are moving. And so we've now seen a reversal of that. And 4 reactors that were scheduled to shut down as we speak in Illinois are now preserved, and they'll be operating into the longer term. There's another 4 that were sitting behind that in Illinois that will now be operating into their longer term. And there's others around the US that will, where their operators will be getting a lot of comfort that they will be able to continue. Really important dynamic. Bank of America put something out in March talking about it, and that piece in itself led to quite a significant uptick in the uranium sector back then. So overshadowed by SPUT, but every bit as important, and it's end user demand that you couldn't have put in a spreadsheet a few months ago.
Mm-hmm. As you're mentioning the shorter term for uranium and maybe uranium equities here, we saw this week some pretty volatile moves. So do you think that some of the pullback that we saw in some of the equities was some short-term profit taking by, let's say, long-suffering investors in this sector?
Undoubtedly, the sector's run really hard. I mean, if I use Bannerman Energy, which trades on ASX, if I use the BMN, we also are on OTC markets, but if I use the BMN trading on ASX, at our AGM last year, we were trading at 3.7 cents. And last week we hit 41. So that doesn't mean that people have lost confidence, but we had a lot of volatility in commodities over the last several days with Evergrande in China and some other jitters. Mm-hmm. So I think it's really reasonable for an investor who's looking at a portfolio saying, I'm sitting on 10 times here. I've got to take something off the table to be able to buffer my other positions that might be looking, quite endangered at the moment. So look, I think it's just a function of any sector and any stock that's really outperformed. When there's general jitters in a market, you're always just going to get that trimmed a little bit. And what's really pleasing, at least for me running our company, is that it hasn't been big volume. We've had about a 25% retracement from those highs. And it just makes my job easier because I can talk to investors and brokers and others about this is a good time to have a look. It's a good time to get repositioned. You can actually get volume at the moment without chasing this thing by 4 or 5 cents. So it's always healthy to have a pullback, and it gives you a basis on which to build for the next leg up.
Excellent. Well, Brandon, I really appreciate all your thoughts today. And of course, you're available on Twitter at Brandon_Munro and also at Bannerman Energy. Anywhere else you'd like to point to?
Yeah, you can follow me on LinkedIn, Brandon Munro. And our website's got some good stuff, particularly on some of the ecological, green finance, ESG aspects. So that's bannermanenergy.com.
Excellent. Brandon, thanks so much for your time today.
Thanks very much, Tom. I enjoyed that.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.